Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Welcome back to another episode of the Australian Retirement Podcast. I'm here with good friend and financial advisor, James O'Reilly.
Hey there, buddy.
Good to see you again.
And you.
And we've got an exciting one here. Not only in recent episodes, you've grilled me, I've grilled you, and now we get to grill each other.
Uh-huh.
We're excited to be sharing a few questions from the audience, which is there's a growing list there, and it can be challenging to get through all of them. We are trawling YouTube comments for questions, not for feedback, and also trawling the community at the same time. So please keep sending those questions through.
Just to be clear, we'll also listen to your feedback, so by all means send that through.
I won't, it's fine. Do you want to kick us off today?
Yeah.
Maybe we've got to, actually, rather than kick you off, we've got some pretty broad questions here, so spanning all different parts. So looking at like the value of the cost of financial advice and what you might get from it, looking at fixed interest and bond investments, and also looking at SMSF. So maybe I'll hand over to you and we'll start the grilling.
Yeah, can't wait. Okay, thank you. And again, fantastic to be here. So we're going to launch straight in. Thank you so much to everyone for your questions. We get a lot of questions every week, and of course we do our best to filter those. So we'll get through as many of these as we can while still making sure that we address them well. But please keep the questions coming, because it really enables us to make sure the content is as good as it can be.
And keep them anonymous with funny names. We have to keep remembering to remind people of this, because this is general advice only. The less information you provide us, the better, and we'll try and paraphrase these questions as much as we can.
Now, the first one doesn't come with a name. So having said all that, we've just got to ignore that bit.
From James.
From James, yeah, I promise it's not me. The question is just comparing some returns of the bigger industry super funds and over the last 10 years, and the cash option, being bank bills, term deposits, etc., has consistently outperformed the bond option, so indexed bonds, which almost every superannuation fund will have. Is it worth taking on the additional risks associated with bonds, given the results of the last 10 years? And does anyone see this trend changing?
I mean, the disclaimers are everywhere. Yeah,
past
performance, no guarantee. It should not be relied on for future performance. And that's my answer to this question. No, well, I mean, you have to get a little bit granular on this, and it's a very specific investment question. So what we're saying is we're comparing the cash option, which basically consider it a bank account within an industry super fund, to the bond option, which we've covered in other episodes. But the bond option is going to be investing into things like government bonds, corporate bonds issued by companies like Woolworths or the Commonwealth Bank, and probably an even broader array of other fixed interest investments. So, and what this person's referring to is the fact that bond markets, which people see as being low risk, have probably suffered the worst period of returns before 2024. I think it was 21, 22, the worst period of returns in their history. In some cases, they delivered negative 15% or negative 15 to 20%. And comparing that to cash, which has just basically provided a positive, even if it's been a small positive return, it's significantly underperformed. And and this is what we always see when we're looking at returns in portfolios, people naturally see a negative. Must be bad, continue to be bad, let's get out of it. But this is a very specific situation has occurred, and a very unique situation in the context of history, where from late 2021, but mainly 2022, we saw the fastest increase in interest rates at almost any time in history before it. So as we know, the Reserve Bank, the Federal Reserve, all the major banks around the world increased interest rates from close to 0% to most of them above 4% now. And what a lot of people, and we know the understanding of bonds isn't particularly great across Australia, and I mean advisors as well as investors in some cases. And what people haven't always understood is that if you're holding a bond that's offering you a 0% interest rate, and the interest rate that you can get on buying a new bond issued tomorrow is higher than that, well, the bond that gives you a 0% interest rate is now worth less.
Yeah.
At a very simple,
correct. Yeah, I'd love to unpack that, because there's one thing that astounds me is that if you wanted to buy a government bond, now to be clear, if you want to learn a little bit more about fixed interest, there's a retirement investment 101 episode we had not long ago, which will cover some of this.
Yep.
But if you want to basically lend money to the Australian government for a few years and say, I'd like that back, at one point in the depths of the low interest rate environment where we thought we might go into negatives, there was a government bond, a 10-year bond at 0.35%.
Yep.
And people bought that and said, that's a good deal. We could be in the negatives very soon with interest rates.
Because everyone else was.
0.35 for a decade is a good deal. So let's imagine, for simplicity, you say, great, and I'm going to buy a $10,000 bond. I'm going to spend $10,000 and hold that. Well, that means every year you're getting back, what, $35? Like it's just such a tiny amount of money. It makes no
sense. I mean, Apple, I think, did like a 30-year bond, similar rate.
Wild.
Yeah.
It's wild. And so, as you've pointed out, because interest rates have grown so quickly, you blink an eye, and in the blink of an eye, 2 years later, you've got an Australian government bond that offers a 10-year bond at 4%.
Yeah.
So if you hold that bond that's earning $35 a year.
No one wants to buy that off
No one wants it, because I can just buy over the counter right now an investment that's exactly the same risk. Yes, it's 10 years to go instead of 8 because you bought yours 2 years ago, but this is making $400 a year instead of $35. So what happens there is that the value of your bond is no longer worth $10,000. Yes, I know I'm going to get $10,000 back at the end when the 8 years expires.
Yep.
But in the meantime, it's going to be much more profitable for me to be in a different one. So I will only buy a bond for, let's say, $7,000 to make up for the $400 or $365 in lost income every year, all the way for those 8 years until I get my 10 grand back. That has crippled particularly long-term bonds, right? And so inside a lot of superannuation accounts, particularly industry super funds, where you've got these long duration bonds that are sort of like multiple year bonds. In that scenario, I'm sorry to say, you are seeing this. They've just been absolutely shelled by that really sudden spike in rates.
And it's essentially a leveling of the market. So if it's the same group, if the same government issuing these bonds, one of them offers 4, another one offers 0.3, there's going to be some sort of balance. And they can be traded every day. So more people are going to want the 4, less people are going to want the 0.3. So more people are selling that and buying the other one. And one of the challenges that industry super funds and index funds have had during that period is you could invest into bonds, but without having that fixed interest rate risk, which is what we're talking about here, or duration risk.
Yes.
So what happened with industry super funds, a lot of them, because some part of it because of legislation, but also the index, is they were forced to be fully invested in those 0.3% bonds, which meant their portfolio naturally just essentially automatically reduced in value. They had no choice to not invest into those bonds. They had to keep buying it and keep tracking that index. And this is why, if you go down to another level, this is why we view, and I think you're the same, view it as important to use both index or passive options as well as active options, because there are circumstances when both of them are useful.
Yeah, definitely. So if we look back to this question around, should I hold on to this? I mean, the first thing to evaluate for mine is that yes, they have performed over the last few years, and they've underperformed, and that really has been as a function of a really unusual period for bonds where rising interest rates have devalued the bonds that people are holding in their hands. Now, the opposite is true. If we had really aggressively falling rates, we'd see bonds become more and more attractive, because suddenly you've got a bond that pays $400 every year, and now if you want to buy one over the counter, you're only getting $35 a year. Well, of course, your bond's worth heaps more now. So it's a two-way game. It goes, depending on the market, you can get the best or the worst of it. Something to be aware of, though, of course, is that this is a small time period in what is a long-term investment, because bonds are a defensive allocation, and if they comprise a small part of your portfolio, if you zoom out, they should do very well and continue to complement your portfolio over the long term, more so than cash, again, zooming right out. But the other part of that is around, if we come back to that analogy of having the $10,000 bond that is only earning $35 every year, you might say, well, right now I'm only willing to buy it for, say, $7,000 because I'm going to lose $400 every year by owning this one instead of a different one. Yeah, cool. But what about if you're on the 9th year or the 11th month, 9th year? There's a month to go until this bond reverts back and gets paid out $10,000.
Yep.
It's not worth $7,000 anymore. I only have to wait a month and I get my full 10. So it's now no longer about the return or the interest rate I'm getting. It's now just about the fact that the capital is going to get paid in a month. So these do revert over time, and it's very likely that we will see that reversion coming through. So I'm a lot more optimistic. It's been a difficult time for bonds, but in terms of the way they complement people's portfolios, I still think that they're a really valuable asset.
Yeah, and the trend is certainly changing. I think there's probably two broader considerations here: is that fixed income is valuable when interest rates are falling or when they're stable, because you're getting a stable income, and if they're falling, you're getting the potential for them to be worth more, as we were talking about. So, and it's clear the trend's changing. Bonds have done well, but it's also central banks around the world are all talking or cutting interest rates at the moment. So it's getting there, and there's greater certainty that there won't be further increases in interest rates.
I've said so delicately.
Yeah, probably the most important fact is that no one is expecting, and we've had this before, further interest rate increases, which means it's probably a better time now, and the trend has certainly changed compared to that period. So the next one, I'm really liking this, and you're probably going to tell me it's a niche reference to some movie I've never seen, but the next question comes from Who Stole My Pigeon? No reference to...
My mind immediately goes to, was it Bill Laurie?
Yeah. It's
So,
12th Man, is it?
Yeah, that's right.
Yeah.
This is
I pulled out a Roald Dahl reference during the week too, which Mon was a bit surprised by. But from Who Stole My Pigeon? I'm 40 with a couple of investment properties. Is now a good time to see a financial advisor? And how much is this roughly going to cost? I think it's a great opportunity to kind of frame probably the type of people you work with, but where financial advice can add value. And also, if I walk in the door, is the till ring straight away?
Yes. Okay. All right. Who Stole My Pigeon? Yeah, I'm sorry to say I'm not quite across this reference, but I like it nevertheless. This question is not one that I can answer directly to you, because you might be the sort of person that is a perfect fit for financial advice and we'd be able to serve really well, but there's just not enough information available. So the questions that I'd be putting back to you in an initial conversation would be, well, what would you be hoping to achieve through a meeting with a financial advisor? Is this about building your wealth more, or are there acute problems that you're experiencing? Are you feeling a little bit lost with what to do next? You've bought these investment properties and maybe you're thinking that it's time to do something different. I think... you were talking about, does the till ring? The answer
There's a lot of misconceptions here.
The answer is no. There's another great question that also appeared in the podcast question set from Ready Set Super, great name, and which was words to the effect of entering 60s with $1 million in an industry super fund. Got a sense of what to do. Is there a minimum where it's recommended to seek financial advice? I've sat down with people in that situation, and indeed in the situation with 40s with a couple of investment properties, and said, whoa, there are so many opportunities here. There are so many things that are not being done that should be done. There are so many opportunities, either problems that we can avoid or just really significant ways to meaningfully improve your wealth. And I've similarly sat for people in these scenarios, and I've similarly sat down with people there and said, it seems to me like at face value, you're doing a lot of the fundamental things really, really well. Yeah. And you might not necessarily need that full scale solution of an advisor to come in and do the holistic check. So there's a question around roughly how much this is going to cost. Financial advice in Australia is getting more expensive. There's a number of reasons for that. The most obvious reason is that despite all the promises that we continue to get, the amount of work that goes into providing someone with advice is insane.
Yeah.
It's
There's a lot of compliance. We've had conversations with people who just want specific advice on a certain issue. But as a financial advisor, we have a legal obligation to consider every part of their situation, and incredibly hard to scale it down.
Yeah. And the byproduct of that is that even as something as binary as should I buy more BHP is a question that is impossible to answer without us asking a heap more questions to you and to better understand your financial situation and how that works, and then providing you with a document that outlines all of the pros and cons of it.
BHP,
which is ironic when you're standing around a barbecue with your mates and you've got 6 of them saying, yeah, you should definitely buy more, Tom. And you're like, geez, okay, this is silly. So that's reason number one. The second reason is because the number of financial advisors has fallen considerably, in part due to the fact that it is a tough landscape in terms of serving people, and there's a lot of advisors that go and do something different to try to find an easier way to serve people. So as a house rule, if you're coming to see a financial advisor and you're open-minded to getting what I describe as full-scale advice, like I'm here and I want to understand how to be better with my finances, and I'm open-minded about what we're going to uncover and how you will be able to add value, I think you should be setting the expectation that you're initial fees are going to be in probably the 4 to 8K space. Now, if we add more complexity and we have more moving parts, it could be higher than that. I think you'll be very hard pressed to get advice for less than 4K that's not extreme, like scale down to let me just review your super or set up your insurances and leave it at that.
Yeah, exactly. And I think there's probably one of the conversation we have a lot at the moment is that a lot of the focus is on that financial plan and the statement of advice, which really can only cover, the next few years. But the true value of advice, a lot of it actually comes from the ongoing support that you get, whether it's the type of coaching that you provide and support around decisions and building good habits, or from our perspective, managing people through, and their investments through difficult periods and ensuring they don't make mistakes during those periods. So it's good to understand that they're both upfront and ongoing advice services. And around costs, and probably the more specialised you get, it's always good to find an advisor that works with people similar to yourself and specialise in that. And then, as you'd expect, specialisation, like in any sector, comes at a higher cost.
Yeah,
which I think is
If we're looking here at your situation, who stole my pigeon, and thinking about is now a good time. I think as a house rule, if you think it might be a good time to see a financial advisor, then start. Start.
And it can just be a meeting. Yeah.
Most advisors that I know would offer that first meeting at no cost. Certainly that first good quality phone call at no cost to get a little bit more granular about
what you're looking for,
some of the finer details to understand how well suited you are. But you certainly should be in a position with any advisor whereby after not too long, you can say, right, before I've financially committed, before I've made a meaningful contribution or commitment to this relationship, in a finance sense, I have a very, very real sense for how you can help, the sort of advice I'm likely to be looking at, the value that I'm going to get from it, whether some of that is real, the real tax savings are here, the real strategic financial benefits are here, or alternatively, from an accountability perspective, hey, you've been saying you're going to do that for years, we're going to actually get that done and I can help you to get that done and we're going to cross that divide together. You should be really clear on that and have a sense of fees pretty early in that relationship, and then you can answer individually, is this worth it for me?
Yeah, exactly.
That's right. So if it's definitely worth going through the process, it's definitely worth investigating, especially as you accrue more wealth. It stands to reason that the value of advice becomes greater.
Because the risk of mistakes becomes greater, or the cost of mistakes becomes greater.
And also the options become greater.
Yeah.
So if you're at 18 years old and you've just started your first role and you've got $0 in savings, then the scope of what a financial advisor can do for you is probably quite limited. If you're 60 with $1 million in super and invariably a whole heap of other things in your financial life, and that's a very fertile time for financial advice.
Yeah, certainly.
All right, let's go across to Nitty Gritty. Love the podcast. Thank you, Nitty Gritty. We would value your thoughts. I've worked hard to accumulate 1.5 mil in an industry super fund in their high growth index option with very low fees. Well played. I've avoided an SMSF as I have no interest in property or private equity in my super, but I'm wondering how much of a drag on my returns I would likely be experiencing due to being in a pooled fund and being exposed to the capital gains tax that's spread across all members whenever the super fund is making changes and switches inside my investment, which of course is happening to anyone who's got a retail or industry investment. So, mate, Drew, do you want to talk to this?
Yeah, I mean, it's a pretty complex one to get into, and I think we're going to take it down there's a couple of directions you can take. And the broader question was almost, is there a benefit in looking elsewhere and looking at other structures? But it is completely true, and it is quite opaque investing in an industry fund. There are subsidising of other members, and you're all sharing the franking credits are a perfect example, and so is capital gains. So what we talked about, and I think a good way to consider this is to think about the returns you're generating from that portfolio and the turnover that is occurring within that portfolio, because that's where the CGT is being attracted. And you couldn't actually, if you looked at the unit price, you couldn't actually measure this. Like, it's not data that is actually provided. So this is all very high level and hypothetical, we'll say, for the moment. But the way we started this was, if you're talking about a $1.5 million balance and in a high growth option, if you're in high growth, you're expecting a return of at least 10% per annum. And for the simplicity's sake, not saying that's what you should get or you would get every year. If you're in high growth, you could get negative results. You could get negative results, negative 10% in another year as well. So you're looking at a return of $150,000 in value every year. And then the question is how much of that is being turned over in terms of money going in and out of the fund. And it's probably higher than we think, and also money going into and out of the individual investments and options within there. Okay. So I think we were starting with a turnover of around...
Well, we can probably save ourselves some time here because they've put down a figure of 10% CGT
on the top. Yeah.
I'm pretty happy with that number because typically if you look at the pension fund returns versus the super fund returns for
about 10% different.
The gap is around 10%. That's
perfect.
Yeah. So happy to assume 10% into 150K, 15K?
Yeah, you're looking at $15,000 in tax you're paying despite making no changes to your investments. Or you're not paying the tax. Your investments are being adjusted for further taxes being paid.
And just to make sure that everyone understands what I'm talking about there, for simplicity, if you go to your industry super fund and you look at the pension fund returns for the high growth index fund versus the accumulation returns for the high growth index fund, as a reminder, it's exactly the same asset and the composition's the same. You'll find that as a house rule, the pension fund is likely to be about 10% higher because instead of being net of fees and taxes, it's just net of fees.
Yep.
Whereas a super fund will be a little bit lower. So yeah, in this case, 1.5 mil, this is a real tangible drag, right?
Yeah, it could be a $15,000 drag if the assumptions are correct. And there's turnover, and there is a lot of turnover, and it's probably why this structure is beneficial to, I think, the masses and maybe smaller balances. Yep. But it definitely comes in the question, and it probably highlights this issue we talk about all the time, which is turnover of portfolios. So if you were to, say, hold the exact same assets in an alternative structure, that could be and again, there isn't just SMSF industry funds. There is a halfway point where you can get the control that you can't have and the transparency that you can't have with an industry fund, but without the cost and work of an SMSF. And SMSFs aren't for everyone. We get that question all the time. But if you are holding exactly the same portfolio of assets and not turning them over, or turning them over, very rarely making changes, and you're buying and holding, your return could be 10% higher than what you're getting at the moment.
Yeah, one of the tricky things here nitty gritty is I guess it depends on how close you are to what we call meeting a condition of release, i.e. moving to a world where your super is tax free and you can freely buy and sell and pay no tax. If you are 40 and you've done a tremendous job to accumulate your 1.5 mil, then 40 is probably unrealistic.
Then it makes sense.
We'll say 50.
Yeah.
If you're there, then you're going to have no portfolio turnover for a decade in order to realize that benefit.
10%, yeah.
That's pretty unrealistic. If there would be a real cost of waiting 10 years with stubbornly folded arms saying, I am not selling because I don't want to incur tax, versus looking at this and saying, hey, read the tea leaves, there are better investment options available for right now and you just need to take the tax and move on. So it's a mistaken assumption to assume that there's going to be no transactions within your portfolio, unless perhaps if you're 59, you meet a condition of release in exactly 12 months, there's a much more high likelihood that this could be a pure 15K.
Yeah, exactly. I think it's the kind of perfect explanation, but it just highlights the nuance and kind of unknowns that are in different types of superannuation accounts as well.
Yeah. This also is one of the reasons why, just before we were speaking to the idea that as your asset balance grows, these things start to become more of a consideration, and the value of advice, the value of what we call, in our business, we call situational alpha. It's like for your unique situation, because you are 57 years old, and we can construct some elements of the portfolio and know that we're not going to turn them over, and we know that we're most likely going to be able to pay no tax at 60, that's where a heap of value starts to come in that you can't necessarily measure. You really have to get more granular about your situation.
Yeah, exactly. And every decision is more material immediately and impactful. So switching to confused epic primer, and you'd have to do some. It sounds like no. I'm still trying to work these out. I've got to work on my zeitgeist references, I think. So confused epic primer asks, in retirement, which fund to draw down first? So confused epic primer has an accumulation balance within super, a pension balance within super, and let's say personal investments that might be managed funds, ETFs, held in their personal name or in their partner's personal name, whatever it happens to be. So the question is, from a from a tax perspective, and we're not tax agents, but where do you typically suggest people draw if they're spending more than their income is producing, and naturally you have to draw the minimum from pension, but where do you suggest drawing the rest of the assets or income from?
The money in pension is very precious, and it's very precious because there's no tax paid on it for most Australians. If you're above 1.9 million and so on, then power to you. That's a different consideration. But because of that, all things being equal, we should be prioritising money that is currently paying tax.
Yep.
Now, your accumulation fund is paying tax, regardless of your marginal tax rate. It'll be paying tax at that 15% internal tax rate. And then we talked about a sort of a 10% differential before, which is probably quite real between the two. It's not clear as to why you still have money in accumulation if you have a retirement pension.
Yeah.
But if there's no logical reason for that, then I'd be drawing down on that earlier than the pension. Now, with the managed fund that you have, which is presumably in your own name, that really comes down to your own marginal tax rate. You might have an investment property or a couple of investment properties that mean that you are paying tax every year. You are lodging a tax return, and that means that you might be paying, let's say, 19 cents in the dollar or 17 cents in the dollar this financial year. So therefore, again, the pension fund would be the most lucrative because it's zero. Now, sometimes you might sit down with a retiree that has no investment properties, their taxable income is zero, and so even though they have a small managed fund, they're not paying any tax on it anyway. So that can be a cool thing. Just be mindful that even though you're not paying tax on it year by year by way of the dividends that you're receiving, if that managed fund has a big capital gain over the next 10 years and you hold it and then you sell it, then you are going to end up paying tax. So again, similarly, having the confidence of saying, well, there's no tax payable inside the pension fund, I think that would be the one that we'd seek to protect.
Yeah, exactly.
And whether or not you do the accumulation or the managed fund is really going to depend on your own marginal tax rate and the likelihood that, when am I going to need to pay tax on the
Yeah, I think the key is you want to keep as much money in superannuation for as long as possible, particularly in pension phase. So as a default, you'd be drawing the minimum from pension, and then, as you said, working your way down from there.
Yep. Let's go across to taxing. For taxpayers subject to Div 293, do you still advise to put the maximum contributions into superannuation? So firstly, what is Div 293?
Yeah, I was just checking on that. Now, Div 293 is basically a top-up tax. So when you make a before tax or a concessional contribution to superannuation, it tracks contributions tax at 15%. Division 293 applies to those who earn in excess of $250,000 a year. And that basically they are forced to apply an extra 15% on the same contributions to superannuation. So your contributions tax rate increases from 15 to 30. Now, without knowing age or specific circumstances for this person, if you're on Division 293, you're above the top marginal tax rate. So you're at the top marginal tax rate, so you're paying 47 cents in tax in every additional dollar you earn, and you're getting taxed at 30% by putting money into superannuation. So straight away,
you're still better.
There's still a 17% benefit by making those contributions. That said, there was one area where if you're a younger person earning in excess of $250,000, there would be a question around whether you want to lock that money into superannuation given the conditions of release, and whether you have better uses for that money, even in after-tax dollars, because you can offset your mortgage or something like that. So in most cases, there's a net benefit. In very specific cases, it may be more beneficial to have that cash in your pocket.
Agreed. Completely agreed. Okay, cool. We've got time for one more?
Yeah, certainly, definitely. Now, this question from Mark is very much focused on superannuation, and there's a lot of different ways we can think about this. But Mark's question relates to the pension phase of superannuation. That what is the right percentage of your super balance to take every year? Mark says, I read often that it should be 3 to 5%, which probably refers to the drawdown rule, which is confusing because the average return of a pension fund is 7 to 8% per annum. On this basis, taking into account inflation at, say, 2%, taking 6 to 8% should be safe unless you're looking to die with most of the account intact. This is a very loaded question, I'd say. There's a die with zero reference here, I think. There's also a after inflation question, and there's a how much should I take question. But let's just go to that highest level. And we've kind of addressed this in one before, but I think there's a more specific answer to this. So what's the right amount to be taking out of your super fund every year?
Hey, Mark. Yep, good question here. I love the detail. You're clearly thinking about this closely, which is cool. So firstly, I think taking 3 to 5% of your pension is too lean. And I think you're alluding to that fact too. You're right. The average return of a pension fund in the current market with rates, the cash rate where it is that your balance fund should be in that 7 to 8% sort of zone, if we do it 100 times. And so as a result, if you're taking 3 to 5, you're actually going to have a pension fund that's growing. Now, if we look at 3 to 5, one of the reasons that number is often touted around is because that often more closely reflects to the cash that you're getting or the cash return through dividends and the like. So therefore, you're not eating into the capital component of the investment. I don't think that's necessary. There's a personal preference here, but we've spoken about that die with zero concept. Unless you've got an acute reason to want to hoard your money in retirement, then you should be enjoying it as best you can, and obviously doing it in a way that's not going to erode all of your assets. But nevertheless, if you're taking 3 to 5 and your fund is returning 7 to 8, then why? Okay. So we want to ideally, in my mind's eye, that 6 to 8. I think that 6% is a good safe number. It gives you scope for your expenses to increase in the future for whatever reason, lifestyle changes, medical expenses, those sorts of things. I mean, notwithstanding, expenses will typically often come down as you go into your later years. But even so, it gives you lots of room, but it still ensures that you can live a really comfortable retirement.
Yeah, I think there's two things people get wrong here. One is following the legislated minimum drawdowns solely. Just look at them and thinking that's appropriate, but that's literally the minimum you have to draw to keep getting your tax benefit. And the other is linking how much they're drawing solely to the amount of income their portfolio is producing. So my answer will be very similar, and it's basically work out how much you need to draw, determine if that falls within these percentages or is achievable, and is where a good advisor will come into it, and be able to provide you with modelling that shows what different drawdowns mean to your balance compared to what the expected returns are going to be. And I think that's the way we address it. Like, start with the how much income you need, and then work back from there, and then adjust the income.
Yep. Okay. Well, let's conclude. We've gone through some good stuff today. So before we finish, we've got a little bit of housekeeping, which is that we're changing a definition here at the Australian Retirement Podcast. In previous episodes up until this point, we've referred to old as being 41 or 42 and over. But on account of Drew having his birthday this time next week, just letting everyone know that number's going to index. It's going to go from 43 and over. So just if everyone can be aware of that when you're submitting questions and the like, please keep that in mind, and everything will run a lot more smoothly.
Appreciate it.
You're welcome. Okay, thank you so much, everyone. Pleasure to do this as always, and keep those questions firing.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.